of the combined company, and he joins us now in a first on CNBC interview to discuss. Greg, welcome. So tell me, this is big. You guys and Udemy are two very big public names in this space. The stocks have suffered since 2021, but you, in particular, Coursera, continue to grow across your universities, business with degrees, the consumer, and the enterprise. What's the rationale for combining?
Well, I think the rationale is pretty straightforward. The world has never needed the ability to skill and upskill more than it needs it today. The World Economic Forum forecasts that 39% of skills are going to need to change by 2030. That is a staggering amount of skill change. And this combination gives us an amazing ability to meet that need. So it unites our consumer business, which we're strong in, as you mentioned, with Udemy's enterprise strengths, creates a comprehensive ecosystem of expert instructors from leading universities, companies, and a dynamic instructor marketplace. And by doing all of that allows us to better serve our core markets with shared innovation, data, and tech, and bring that to learners around the world. A combined company has more than 270 million learners around the world and nearly 20,000 enterprise customers.
You say you can get annual run rate cost synergies of $115 million within 24 months of closing. How do you do that?
Well, obviously, there's a lot of work that's going to go into that between sign and close. But we believe there are real opportunities to look at where we can be more efficient across sales and marketing, G&A, and ensure that we're continued to be able to invest in the future of the company by bringing more technology to our learners and enterprise customers, and really leveraging AI to accelerate the pace of innovation for the combined company. By doing all of that, we're confident that those $115 million of annualized run rate synergies are going to help us get to an expanded adjusted EBITDA margin that is closer to 20%, which is really compelling from a shareholder perspective.
Does the Udemy brand survive? Its consumer business really hasn't been growing recently while you have. So what happens with the brands? What do you emphasize versus pull back on, assuming these two brands combine as you plan?
The brands will combine. They will live on underneath the Coursera brand. And obviously, we'll be really thoughtful about how we do that. We are big fans of the strength that Udemy has, in particular with their enterprise business and their dynamic instructor marketplace. Those are two incredible assets, and we want to build on those. And we believe that the combination of the two entities gives us the ability to have a shared technology platform and a single brand that delivers more value to individual consumer learners and enterprise customers.
You and I have talked recently about the role AI is playing, particularly in driving demand for Coursera's business right now, as so many workers try to upskill, enterprises try to upskill their workers. I also wonder what effect you're seeing in customers, enterprises trying to use AI on their own to upskill, and to what degree Udemy has something to add to what you already have and have built out.
Well, Udemy has a thriving enterprise business with 17,000 enterprise customers, and they leverage AI and MCP to deliver that in the workflow for some of their enterprise customers. We believe there's an opportunity to combine that with our strengths on the consumer side and really provide a much better foundation. Obviously, all of Udemy's enterprise customers will also gain access to our amazing catalog of content from the leading universities and industry partners. So we think there's an opportunity to really double down on all of that and really expand the opportunity and the ability to better serve those enterprise customers as they're looking, how do we upskill and reskill our workforce to ensure that they have the right talents, the right skills for what their job needs today as that changes at an unbelievably fast pace.
Finally, Greg, so feel free to add whatever concluding thoughts you have in here as well. Duolingo, last quarterly report, announced kind of a retrenching, a need to reinvest in the foundations of what they do because of this AI opportunity. As you look at this combination, how much cost might you have to pour into it as well to standardize the platform across both companies? What should shareholders expect?
Well, obviously, there'll be some one-time integration costs, But one of the benefits of this combination is that we'll only have to have one platform, not two separate platforms. And so as we work through that integration, we'll be able to invest more in a single platform that serves a larger customer base. So that investment obviously gets amortized over more learners, more enterprise customers, more revenue. And the adjusted EBITDA margin and the profile of that improving so dramatically gives us a foundation that enables continued investment to ensure that we're not just keeping pace with technology change, but we're also enabling our enterprise customers to do that themselves as well by serving them better.